Jim, for our viewers to know, I mean, you and I have now known each other for years. I don't even know how long, but I've had many, many interviews with you, which I appreciate. And I also appreciate, I think you've got an out of consensus call today, which we'll get to, but we want to break down kind of what you're seeing from a big picture macro perspective before we get to that. So as I look at it right now, the market really, from a consensus perspective, believes that we will have some type of soft landing. But of course, there are the concerns about a hard landing. From your perspective, without giving the conclusion yet, let's break down what you're seeing, because it's really a bit of a debate in terms of inflation versus deflation, what the Fed does next.
Sure. So we've been in the soft landing camp since late last year. We think that the Federal Reserve and the Bank of Canada have misdiagnosed inflation. And the narrative last year was all about the Phillips curve was caused by wage or the labor market. And we know that to be false. We think that we have experienced a historic period of time because of COVID of fiscal policy and monetary policy to the point where we should not be surprised about inflation. But the fact of the matter is that this is not the 1970s. This is more like post-World War II. The supply shocks are coming off. And I think the big problem that people have is they're just impatient and they want it now. So we would suggest that inflation and the way that the Fed measures it, we're going to see headline inflation under 3% in the fall. And we would suggest that the Fed is going to have to start cutting rates to support economic growth, because we agree with the IMF and the World Bank that we're heading back to secular stagnation and deflation.
Okay, a lot there to unpack. I want to first go to something you said, that there's a misdiagnosis in terms of why we have inflation. In other words, there's a lot of people and a lot of the Fed are concerned that wage increases is what's going to lead to sticky and higher for longer inflation. And therefore, that's why they presumably want to cause a recession, because once you have higher wages, it's very difficult to roll that back or pull that back. But you're saying it's not that at all. It's really due to the stimulus that was inputted into the economy, $4 trillion during COVID. That is the cause for inflation, correct?
I think that's fair. Yeah, when you look at the inflationary expectations, there is no inflation. I mean, the five-year forwards are below where it was in 2010, right? So it's a great fear. It's a great narrative. But I really think that, if you look at the data, what you're seeing is that a significant portion of the inflation and the economic growth created was by the fiscal policy. I mean, look at the reports from the Fraser Institute up here saying, somewhere north of 75% of job growth since COVID was the government. That's not the private sector, right? Rate hikes don't fix that. Quebec just raised the minimum wage. Right? That's not the private sector. That's fiscal policy. So eventually all of that's going to wear off. The monetary stimulus is going to wear off, and we're heading towards a severe deflationary episode that I don't think people recognize.
No, they don't, because we're still really trying to figure out, and the Fed is in particular, and that's where we get our cues from, and the Bank of Canada, of course, that inflation is the issue. People are still feeling the effects of inflation, though, Jim.
Yes, but let's look at the real effect, right? Like, so in the States, real retail sales were negative, right? If you take into consider price increases, they're negative. The economy, productivity in the labor market is negative. I could bore you ad nauseum about how the data coming out of the Bureau of Labor Statistics is wrong, and we need to get up to a gig economy type of evaluation. Real-time evaluation of inflation right now, not by the BLS, but by other measures, is about 3.4%. And we have yet to start seeing the effects of real estate prices that were basically mischaracterized in the inflation data to start to kick in. So we think deflation is going to be the risk moving forward for the rest of the decade.